sir, okay, sir. Sir, with your permission, can we start, sir? Money 4. No, 2 minutes wait பண்ணலாமா sir? Actually, இருக்காங்க sir. Registration இருக்கு, but இன்னொரு 2 minutes வேணும்.
ஞாயிற்றுக்கிழமை என்ன அவ்வளவுதான் கொஞ்சம் நம்ம ஆளு எப்படி no, this is the only profession where people do hard work and less leisure. So, at least Sunday பரவாயில்ல.
Sir, we will start, sir. So anyway, நம்மளோட proceedings எல்லாம் ஒரு 5-10 minutes.
ஆமா.
Okay. So anyway, so good afternoon all the members. We welcome you to the budget session, which a renowned speaker, so CA Palguna Kumar sir will be handling this. So before stepping into the session, I request the members to kindly rise for the motto song.
Yaesha supteshu jagrati, Yaesha supteshu jagrati, Kamam 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 Pursho nirvimana Tadeva shukram Tadeva Brahma Tasmin lokaha shitaha sarve tanuna tyadikashchana etadvaita
Thank you all the members. So anyway, today we have gathered for getting the insights of the Union Budget 2022. Anyway, see, as a professional, from the day of budget, we would have been receiving all the calls from our enthusiastic clients or the stakeholders, in fact, to understand the benefits, what they have obtained in this budget. But anyway, say we have to be happy with this. So this was absolutely an driving it towards a direction of an socio-economic development. That's what I see. So, but say more than all, I would say that this was in somewhere the budget wherein the investment was really towards the infra, logistics, tourism. So all these are going to really, I feel like it is going to create employment for a common man, and also opportunities for business people who really are into that job or allied activities. That's what I see. But anyways, as now even though we are confined only to the direct tax, we are going to apart from the updated return, there are also other provisions which has been expanded. That's what the tax base has been expanded. That's what I see. Anyhow, we'll be hearing in detail from our renowned speaker. But apart from this, we know we have to handle a session separately on indirect taxes. So how I'm really surprised what the government has taken on the indirect tax. In fact, I feel like it has tarnished the charm of GST and the cascading effect by bringing some draconian provisions for ITC. Anyhow, at some point of time, so we will be having the CP in this month. So we will invite a speaker and we'll understand the basic, what are all the indirect tax provisions that has been changed. So suppose before that if bill comes, and we'll also be very hopeful to at least these provisions have been excluded from the when it comes to the act. But so with this brief introduction, I hand over the session to our Vice Chairman, who will be introducing our speaker for the day. Over to you, Vice Chairman.
Yeah. Good evening, sir.
Good evening, Patrivet.
I am here to officially introduce our speaker, who is well known to our branch, especially he used to come every year for the installation of the new managing committee. This year, due to order, we are not be able to call him in physical, but at least we are calling him for the budget session as usual. Dr. C.A. Palguna Kumar is a fellow member of our institute, and he is in practice since 1979. That is for the past 42 years. My age is 43. I born in 78. So my age is my experience. His experience. And he is a managing partner of E. Palumar. He is aged about 55 years. He is married to Srimati Vijayalakshmi, who is a doctorate in home science and worked as principal of Govinda Raja Swami Art College in Tirupati. They are blessed with two children, one son and a daughter. Both of them are qualified CAs and practicing with the father. Daughter-in-law is also a CA practicing in this form. He is a classical flute player also. His educational qualifications are MA, MCom, MBA, BL, DESA, and PhD. He is a member of Institute of Company Secretaries of India also. He was a member of Regional Directors Advisory Committee. He was appointed as a member of Board of Studies of SV University and also SP Mahila University for the period 2012 to 14. He presented more than 376 technical papers in the past in various CPE forums. On GST, he has delivered more than 50 lectures across South India. He got doctorate in accounting and auditing standards for MPO from Sri Venkateswara University, Tirupati. MPO stands for non-profit organization. He did it PhD. He is serving the society as trustee and executive member of several charitable institutions at Tirupati. He has been appointed as a finance committee member for 3 years, 2022, currently of IIT Allahabad. He was elected to the SARC of ICI in the month of December 2009, 12 and 15. He was chairman of SARC for the financial year 2016-17. With this short and sweet introduction, I welcome the speaker for the session. Over to Chairman.
In fact, speaker, there is a sir. You can handle the session, sir.
Thank you. Om Namo Venkatesaya, esteemed chairman of Dynamic Tiruchirappalli branch, Mr. Arun Mahesh, Vice Chairman Matrivel and other committee members. I have several other friends in Tiruchirappalli. Whenever I come, mainly I come to see the deity and also the professional friends. So my professional friends have been helping me to serve both the causes, Punyam Purushartham, Rendum Seri. So as in the past, without fail, the present chairman promptly called me before the budget itself. You have to present a paper on the budget, sir. Okay, due to COVID, I may not be able to come physically, as I have accepted to in this webinar mode. You are giving me an opportunity to go through the provisions meticulously to the extent possible. I will try to cover within these 2 hours. What are all the implications? Our chairman has started with a happy note that the country technologically is progressing. Government has taken all the measures to increase the GDP or stimulate the growth of economy. Definitely, when the economy grows, as financial experts, we are going to get our share. In the sense, the need for financial services, financial experts will increase. Definitely, it is a good sign. I agree with him. I have to supplement his words. Though the government mainly says to reduce the litigation, to give consistent tax regime, to make easy compliance, these are all the good words. The government intention is clear. But when we go through the provisions, a lot of litigation is possible. Compliance is becoming more and more year after year. The 3 new TDS sections introduced itself says that compliance is still increasing. So the 3 new penalties are also introduced in this budget. So the intention of the government is laudable, but still it is very difficult both to the businessman and to the professional to 100% comply the law. The government, as we have seen 2021 June 1st onwards, the new technology, new platform of the income tax department, around 50 areas covered by this annual information system. The 26 years is supplemented by the new data collection and presenting. With all this, which is mentioned in the statute itself, that risk management strategy. Who is having the risk? Assessee is having the risk. Department is not having the risk. So the assessee is filing the return with risk. So many conditions are being imposed. So though the budget seems to be overall easy way and only simple thing, when you go into the provisions, I find some difficulties, practical difficulties. Anyhow, the happy note is the growth, GDP growth in the past 1 year and the projected 1 year also through this budget is above 8%. So the GDP growth is the highest. The economy will definitely grow. The government, though in 5 states elections are next month going to be held, has not budgeted to give freebies liberally to satisfy the people. So thereby inflation is under control, we can say. So the inflation, though there is a fiscal deficit which will cause to some extent the inflation, so the bank interest rate is lesser than the inflation rate according to me. So it is not wise for our money to be in the bank. It is more wise if the bank money is with us. So to the extent possible, a wise man should take the risk of borrowing from the banks and then investing in good areas, maybe equity, maybe gold, maybe land, so maybe mutual funds, debt funds. So this is how the economic overall view is there. But anyhow, my subject is direct taxes dealing. So I will straight go to the direct taxes. Normally, the expectation from the direct taxes from the employees or from business people is to give some threshold, basic threshold limit increase or savings increase. ATC people expected from 1,50,000 to 2 lakhs, or say employees expected at least the standard deduction 50,000, because goods and services have become costly. So they want instead of 50,000, 75,000 minimum, like that. Some increase reliefs they expected. The government has not given any reliefs. So to start with, there are no changes in the basic limits or say tax rate, basic tax rates, but it has rationalized some of the items linked with the tax rate. Number one, the surcharge. The surcharge was limited to 15% on the long-term capital gains, that is shares and securities 112A, or say the 111A short-term capital gains. So as we know, the surcharges in the past 2 years have been raised from 10-15% to a maximum of 37%. That means a person above 5 crores income, in addition to 30% tax, 37% means roughly 12%. So 42% tax he is paying. So in case such income includes these shares and securities related, because they want to increase the public stake in the stock market, thereby it is an indirect impetus for companies to enlarge, grow with the public money, public participation in the share capital. So the 15% limiting of surcharge instead of the maximum 37% or other slabs of surcharge to section 112A long-term capital gains related to securities, or say section 111A short-term capital gains, or the other source dividend. Dividend has become, earlier dividend was exempt, now dividend has become taxable from 21-22. So the present budget has extended that 15% cap on the surcharge to other long-term capital gains also. So other long-term capital gains are in section 112. Shares and securities long-term capital gains 1 year. Immovable property long-term capital gains 2 years. Other long-term capital gains 3 years even now. So that other long-term capital gains, normal long-term capital gains under section 112 also is now restricted to surcharge of 15%. Only if the other income is crossing the threshold limits, then the question of 15% again being enhanced. First of all, the surcharge is applicable, as we all know, for up to basic 50 lakhs income, no surcharge. 50 lakhs to 1 crore, 10%. 1 crore to 2 crores, the 15%. So the other income, if it ranges only that 15%, 25%, 37% is applicable. Now for long-term capital gain, they restricted. Similarly, the government wants to give a special limit to the 15% surcharge. Normally, 2 or more persons carrying on an activity, unless it is covered by the partnership, is an AOP. AOP is an assessable person. Several of the turnkey projects of the government of India, or in any, say for example, one university is in collaboration with a foreign university, is starting a research project. It is an AOP. Or 2 limited companies participate jointly in a tender for a Chennai Metro Rail Corporation contract, then it's an AOP. So for their income, because the 2 limited companies though come as a joint venture, their income will be as AOP taxable, and afterwards the same income will go as dividend from this company's, the joint activity. Again it is going to be taxable in the hands of the company, and when the company distributes, again as dividend in the hands of the shareholder. So the government now in this budget has restricted for such JVs, specified ventures, which are ultimately assessed as AOPs, the surcharge is limited to 15%. So next, for cooperative societies, the surcharge is 12% when their income exceeds 1 crore. Now they have given a new slab for this application of 12%. 1 crore to 10 crores, the earlier 12% surcharge is now reduced to 7%. And only when the cooperative society's income exceeds 10 crores, then the surcharge 12% will come. Here I should mention, as a practitioner, my observation. Majority of the cooperative societies which are enjoying ATP benefit because of principle of mutuality. Because of principle of mutuality, for example, farmers cooperative societies, they buy the fertilizers, they sell with a nominal margin to the member farmers. Farmers produce also is sold through the cooperative society. These cooperative society ATP 3 years back from 2018 onwards, unless they file the return within the due date, Section 80 income-based deductions are not eligible within the due date. Because to get the ATP, they must get their books audited. From 2018, though 3 years lapsed, majority of the cooperatives even now are not aware of this restriction, that unless they file the return within the due date with audit report, that ATP benefit. Because all this year, 10, 15, 20 years past, they have been enjoying ATP unconditionally. They are still under the impression that, yes, we can get the exemption. No. So it is now restricted. So for all the 80 income-based deductions, unless the return is filed within the time, just as you have seen in the case of charitable trust also, till 2017, within the time the return filing, audit report filing was not mandatory. From 2016, 17, 18, they amended 3 years consecutively that audit report should be within the time, return should be filed within the time. So in this now tax audit season, I advise every chartered accountant, give priority for the 12AA registered, now 12AB registered for 2021-22 financial year. Give priority for the charitable trust. Tax audit, even if it is belated, maximum 271 capital B, 1,50,000 rupees, 0.5% of the turnover, maximum 1,50,000 rupees. Whereas for a charitable trust, if you don't file the return within the time, you lose Section 11 exemption, though you have a 12A registration, heavy taxable income. So that's how here cooperative societies, I made a passing reference that all the cooperative societies to enjoy their ATP benefit shall file the return of income. Thereby 1 rupee tax may not be there. 100% their income is exempt under ATP on the principle of mutuality. You please kindly advise them. Then for cooperative societies, another amendment this year is, apart from reducing the surcharge rate for the particular slab, AMT is also reduced from 18.5. Alternate minimum tax is reduced, applicable to cooperative societies also. So for limited companies, 115 JB MAT we have seen. For other than limited, it is alternate minimum tax 18.5% was there. It is reduced to 15% in the case of cooperative societies. Now, for the domestic companies, we have seen the present government, in order to reduce the tax rate from 30% for domestic companies, it has reduced to 25%. Now the limit is enhanced, the turnover limit. In the preceding year, the turnover is less than 400 crores. For a domestic company, if the turnover in the preceding year is less than 400 crores, instead of 30%, 25% tax rate has to be applied, liberal tax. Similarly, we have seen Section 115 AAA for domestic companies. If they want to opt, just like individuals, 115 BBC, they are given AAC, they have given the 2 slab rates. Either you go for the new lower rate of tax, foregoing your exemptions and deductions, individuals. So similarly for the limited companies also, if they forego their loss carry forward, additional depreciation, exemptions and deductions, then 22%. For 115 AAB, the new manufacturing company startup, which last year was extended from 22 to 23. Now this year budget has extended a new manufacturing company. started after 2016, before 31/3/24, if it is deriving income, this income is taxable at 15%. So the date is extended for this companies. Now I will go. These are all the rates primarily. Important amendments are there. Four, 5 topics, important topics are there. The first topic in this budget is virtual digital asset. So this virtual digital asset, normally cryptocurrency, bitcoins, we have been hearing in the past 2-3 years. People have been demanding that Bitcoin cryptocurrency shall be recognized. Whereas in the past 1 year, you have seen in the newspapers that Reserve Bank of India is going to issue new digital currency. Reserve Bank of India is going to issue, as on this date it has not, but it has already policy framed and announced. Reserve Bank of India is also going to, because some countries have permitted the cryptocurrency, Bitcoins, cryptocurrency, whereas Indian government, as the policy said, we will not allow it. Because the Indian government perceives a danger that through that route, some foreign currency will come into India for prohibited activities financing. So the government is not interested. You would have seen even the Foreign Contribution Regulation Act in the past 4 or 5 months, how strictly implemented by the central government, because very few people, maybe 5 to 10% of the non-profit organizations are resorting to some unwanted things. So all the genuine public charitable institutions, non-profit organizations, otherwise called as NGOs, are put to harsh test to comply with the Foreign Contribution Regulation Act. So the new definition is given to virtual digital asset. A new definition section 247A is introduced in the definition section, because first they have to define what it is, then how to tax it, how to bring it within the TDS fold. These things are this budget has dealt with through 5 different sections. So first definition section, the virtual digital asset, an exhaustive definition is given. What they said, virtual digital asset includes a token, non-fungible token also, either a code or an information or a number or a mere number. So excluding the Indian currency and foreign currency, which is physical currency, excluding this currency, through the electronic mode, through the digital mode, if someone develops a code, a token, an information, which is having a value and is transferable either as a unit or as a by some other name, then that is called as a virtual digital asset. This is the definition part. So we have seen the bitcoins, we have seen the generally majority people, even uneducated people, if they buy a smartphone, first thing what they do is install the WhatsApp. WhatsApp says our policy, it is a encrypted from end to end. Even the WhatsApp management wants to listen or see, nothing they can see, nothing they can listen. So that is what the WhatsApp technology says, encrypted. In fact, when I am talking to you, so the digital transformation as it is will not go, just like your ordinary old phone where sound will travel through electricity. Now in this electronic age, digital transformation is, it will get so many conversions from one end to other end. So this is known as encryption. So this cryptocurrency is like that. Through the digital mode it is created. So some people said a 5 years boy singing is also now a digital patented like thing. So that is they give a say patent like thing, a fixed thing, then they put it for sale. So a digital painting, they obtain a number for it and then they put it for sale. So like that, so many things, any information or say code. Now, the income tax department is facing a question: is it a capital asset? First of all, is it an asset? Even now in the budget on February 1st, they defined this as virtual digital asset. Is it an asset, first of all? Because we are having the definition in the Income Tax Act, Section 214, capital asset definition. Capital asset is an exclusive definition. What it says: any property excluding stock in trade, excluding agricultural lands and so on, so excluding say personal effects. So any property is a capital asset. So here, a right to receive money, a right for something, is it a property? Maybe. So the digital asset, the cryptocurrency or Bitcoin or like these things, or tokens, unfungible tokens, like what they said. So it is a asset. If it is an asset and asset transfer, assets we can have either as capital gains chapter, it is taxable. If the same asset is being used as a business asset, then it is taxable as a business income. Land itself, one or two transactions you are having, land sale is capital gain. 10 sites you bought per year, 5 sites you sold per year, second year you continued, third year you continued, it is a real estate business. So this digital currency, digital assets can be business income, can be capital gains income for a normal taxation point of view. But the government, by defining this, what they want through this budget, they want a special rate of tax. They introduced a new special rates tax. We have seen from 2013, 115 BBE, even earlier, 115 BBC, anonymous donations in the case of charter provision, 30%. 115 BBE, where the income is covered under 68, 69, 69 ABCD, a special rate of tax. During demand, it was 2013 onwards 30%. Now during demonetization period 2016 December, this 115 BB is enhanced to 60% with a special surcharge of 25% on 60% coming to 15, 60 plus 15, 75, and the education cessor at the rate of 4% coming to 3, 78%. And if it is not paid as advance tax, again a penalty, 271 AAC 10%. So 88% minimum it will go once a person is caught in 68, 69, 69 ABC. Similarly, this 115 BBH for cryptocurrency like assets, any virtual digital asset transfer, if it is yielding income, that income shall be subject to 30% tax. Riders: A, only cost of acquisition will be given as deduction in computing such income. B, no expenses of such transfer will be allowed. So buy a stock exchange limited company share, your buying brokerage is cost. When you are selling, you pay the brokerage, that is the cost. So whatever the expenses of transfer if you incur in computing the capital gains, the expenses of transfer are deductible. Whereas here, virtual digital asset transfer yields some income. That income is straight away taxable at 30% without deducting any expenses except the cost of acquisition of that asset. No loss under any other head can be set off against this income. This loss, virtual digital asset sale, may result in a yearly loss. That loss cannot be set off or cannot be carried forward. These are all the riders in this new section introduced 115 BB. So for the sake of these assets, they have introduced. Then they have introduced one TDS section for this 194S. What is this 194S? They say any buyer of a virtual digital asset shall deduct on the consideration, sale consideration, 1% before paying to the seller. Now, if you are buying listed company shares, if such one person is there, where you are buying, you will buy through a broker. The broker acts as a broker only through stock exchange. He tries to buy on your behalf. So actually, who is transferring the share to you? You don't know the person who is the seller. Similar is the case in these digital assets also. Most of these digital assets are Bitcoin, cryptocurrency are traded through exchanges. So this Bitcoin digital currency is digital currency, why we call these units, or say these Bitcoins is a unit, or say this cryptocurrency is promoted abroad, mostly the foreign exchanges. They issue these things. So if you want your investment to be converted into dollars, they will convert into dollars and pay. So if you are buying, you are selling, you as a buyer individual, to whom you pay the money? To the exchange only. So you have to deduct now in the name of the exchange only that 1%. Or if you are selling, let us say, your cryptocurrency you are selling, then who is buying? The exchange is only buying, because you don't know who is the other party who is buying. So maybe this TDS section is made effective in the budget from 1/7/22. Maybe before that 1/7/22, they will issue the guidelines to whom it is applicable, to whom it is not applicable. But now in the section itself, what they said, in the section itself for 194S, what they said, from the sale consideration, the buyer has to deduct 1%. They want to keep track of who is buying, who is selling. Number one. Number two, the specified persons, if the transaction exceeds 50,000 only, this is applicable. Who is a specified person? Just like your 194C, 194H, an individual or HGF whose gross turnover in a business 1 crore exceeds, professional whose turnover exceeds 50 lakhs, they are the specified persons. For them, if they are buying for less than 50,000 rupees, this TDS 1% will not apply. So in other cases, whoever is buying other than the individual HGF, maybe LLP, partnership firm, limited companies, the limit of 50,000 is reduced to 10,000 rupees for this section of 194S, which is a new TDS section only in the case of transactions of buying of virtual digital asset VDA. So this virtual digital, when they are buying, subject to this threshold limit, 1% has to be deducted. This is the new TDS section. Now, buying, sale consideration 1%, forget. If one transfers to other without consideration, then also the 56,210 is roped in. So 56,210 is now, as we all know, from 18-19 assessment year, 56,210 has come. Earlier 56,207 and 7A were applicable up to 17-18 assessment year. 56,210 now says, under the head other source income, any person receiving without consideration or for inadequate consideration, A, immovable property, B, money in excess of 50,000 rupees, C, movable property, specified property. Property means their shares, securities, jewelry, they have specifically mentioned. Now, from this year onwards, from 1/4/22, this virtual digital asset is also included in the property definition of 56.2. So, as per this 56.210, if a person receives as a gift without consideration or for inadequate consideration, then it becomes income of the receiver. So 56.210, as we all know, capital receipts, specific capital receipts are brought within the purview of other source income. But even now, capital receipts which are not taxable, it's a very big subject for 2 hours one can discuss. Even now, even after these so many amendments, still some capital receipts are out of the purview of the either the capital gains chapter or the other source. They leave alone. So the virtual digital asset, which is the hot topic given by this budget, has thrown in two controversial things. Number one, the government on one side is saying we don't allow the cryptocurrency, even if somebody is doing, it is not a permitted business or a permitted activity. In fact, government wants to prohibit it. For several other things, it has not totally prohibited it, but it's not a legalized one. But the Income Tax Act, because of several Supreme Court decisions, say that Income Tax Act is not worried about a person's earning, whether it is a legal income or illegal income. On the lighter side, when I was a CA student, 75 to 78, one cinema actress was raided. At that time, 70% was the tax rate. Highest income tax slab rate is 70%, even higher also. So my senior, who was dealing some film cases, used to say, one film actress were raided by the income tax people. They asked, you have declared less income, but you are having all the assets, cash, hard cash. Sir, I earned by some other means. What is the problem for you? Collect the tax and then go. She gave in writing because their auditor told her, even illegal income, if you declare, it is a lower rate tax on. You declare it. That's all. So in those days, smuggling was a very big activity in Bombay in those days. So all the smugglers were also taxed. For their income, they declared it. So illegality from other statutes may be illegality punishable. Under the Income Tax Act, you pay the tax. So this is about the digital currency, number one. Number two, so the government, by giving this definition, has stated by notification any other digital asset we can declare as VDA. Similarly, it said reverse also. By notification, any other digital asset we can exempt also, because RBI is going to issue the new digital currency. So the government digital currency, they may exclude. So they reserved this right while giving this definition. Whatever is included in this definition is includable, with a further right by the government, to the government reserved, saying that any other to be included or excluded is having the right by notification of the government. So this is all about the digital assets. A new taxation provision has been. Now the question comes. So for earlier years, though this section is new section, TDS is going to be from 1722. So this for earlier years, how it is going to be. So they simply said for earlier years also, the income provisions will apply, though the specific rate cannot be applied. Earlier years also it is applied. So some people admitted this as income to be on safer side under the head capital gains chapter. There is an asset transferred. So some people admitted it under the capital gains chapter. Some people admitted it under the head business. So they get the more advantage of say setting off the losses. So like that. So it was the past, but now they have not specifically said, but indirectly it is coming under the other sources, because the argument, the special rate of tax says any income on account of transfer of virtual digital asset is taxable at the special rate 115 BBE. Now I have quoted earlier the 115 BBE, 68, 69. We are going to touch 68 also. This budget also they are tinkered. We are going to see once again. So this 115 BBE is not talking about the head. It is talking about the section only. Income computed under these sections is taxable at special rate. So this income, where it is falling, definitely, though it is not mentioned from 56 to 59, the income from other sources head, 68, 69 fall beyond the other sources head in the Income Tax Act. But even then it is the other source, it is not other source income, it is other income. So similarly, this virtual digital asset, in my view, is not a capital gains head income, it is other income, not even other source income. It is an other income brought by a special rate of tax. So with this, I will close this, because we are having several other say important things. The biggest, or say pages wise lengthy amendment what they brought is this time charitable trust. As in the past 15 years, there is no budget without touching the charitable trust. So this time the charitable trust is the biggest area where number of amendments have been brought in. So I will go first with the specific donation given to a church, gurudwara, mosque, masjid for its repair and renovation, where it is eligible for ATG subsection 2 deduction in the hands of the donor, because if the government recognizes a particular church, temple, gurudwara, mosque, and for its old say physical condition, if a repair and renovation is going to be there, the government gives a particular registration under ATG, they can receive, because religious purpose ATG is given only for other than religious institutions. Along with 12A or 12AB, ATG will be given in 99% normal circumstances. But ATG 5 deals with all these charitable institutions. ATG 2 only in the case of religious institutions. Apart from government funds, ATG 2 deals with religious activity also, specifically eligible for ATG deduction in the hands of the donor. So now, if such institution is receiving a specific donation for the repairs renovation, it will be exempt only if the money is used for specific purpose. The same year you received, same year used, no problem. It is not income in the hands of that religious institution, because every temple is eligible for 12A registration. Every temple also, just like charitable institution, shall file its return of income, even if it is managed by Tamil Nadu Hindu Religious and Endowment Charitable Act. Endowment department, though managing a temple itself is a separate entity, shall obtain 12A registration, now the 12AB registration, and then file its return of income, claim the exemption subject to these conditions. So still, as I believe, some temples are not obtaining. So that's why I am stressing this point. So in case they received the money for specific purpose, repair, renovation, but they are not able to use it, then as per section 11.5, that money shall be invested or deployed in a specific mode only, and then use it for the specific purpose. So if these things are not done, then it becomes a taxable income. This is one important amendment they have brought in. Second, in comparison with section 11, 1023C is having, section 1023C is having main subclasses, 4 subclasses it is having, and 1020C is having 20 provisos: provided, also, provided further, provided further. 20 provisos were there as on this day. Now, for those provisos, explanation 1, explanation 2, explanation 3, 8 new explanations are brought this year. All these explanations are only to sync 1023C at par with section 11. So in section 11, even now one item they missed, even in this budget also, which I have been saying. So for example, section 11.1 explanation 2 says, in case in 1 year you are not able to apply 85%, in the immediately following year, you can use that money by filing form 9A electronically. So such equal provision is not there even now under 1023C. But several other provisions are now brought in. They made almost the 1023C at par with the section 11. For example, section 11.2, where you are not able to utilize 85% of your income for application during the same year, you can file Form 10 and accumulate for 5 years. Here also under 1020 they brought it. So like that, they for the third proviso they inserted a explanation. Only 2 explanations were there: explanation 3, explanation 4, explanation 5, like that. So they have added so many things. But this year the important thing is in section 11.3, in case the accumulated money 11.2, you are not able to use within the 5 years maximum period, it becomes the income of 6th year is there on the statute. Now this year amendment is no question of 6th year. If you are not able to use this money within the maximum given 5 years, then in the final year in which you are, for example, instead of 5 years, you thought within 3 years itself, you filed Form 10 only for 3 years, then it becomes the income of 3rd year only. If you are not utilizing, it will not become 4th year income, which was there earlier. Now this year amendment, and now hitherto what you are not able to utilize, though it becomes income. If you had spent some money from accumulated funds, already accumulated funds, if you had spent that money, even then expenditure would have been more, tax liability will not be there. This year the speciality in this charitable trust is they want to tighten all the 4 corners, collect maximum tax. What they said, 3-4 ways they said. I am going to explain one by one the amendments this year proposed. Once you are not able to utilize the money, that money, just like your 115 BB, just like that 115 BBH for cryptocurrency I said, here also a new section they have brought in. What the new section is, 115 BBI for cryptocurrency, 115 BBH. Now for charitable trust, a new special rate section they brought, 115 BBI. What this section says, by whatever means something is becoming taxable. What is the existing provision? Existing provision is, in the case of charitable or religious institutions, in case it is having taxable income, just like individual slab rates, basic exemption 5%, 20%, you have to apply. This is there in CBTD circular number 320 dated 11/1/1982. So CPC first levies the maximum margin rate as per section 167B, and now when we quote this CBTD circular of 1982, yes, ordinary rates only. They have put a full stop in this budget, saying that no question of individual slab rates, no question of 5%, 10%, leave alone. They introduced this new slab section, special rate section for charitable institutions. In case it is not able to use its money for the specified purpose and it is becoming a taxable income, straight away 30% tax they have to pay. So this is how the new slab rate is introduced first time for these charitable institutions. Similarly, the 1023C or section 12 registration, charitable institutions shall submit an audit report. Majority chartered accountants, lawyers argue, you said we have to give the audit report. Where is the mandatory books maintenance section? For a business head, when you say 44AB, it is preceded by 44AA. First, books are prescribed. Books should be maintained to give a true and fair view to compute the business income. For charitable institutions, section 1112 or say section 10 to say there is no books maintenance section. That to plead legally, now they made good the deficiency. Books shall be maintained, preserved for 6 years. All these books maintenance section is now brought in by amendment, and audit report within the due date of that audit report, that is 1 month before the due date of filing of the return, is now brought in both in 1023C and section 12. Then the violations. Now the 12AA registration or 12AB registration, cancellation provisions for that. In the old 12AA, we were having 12A subsection 3 and subsection 4. From 1/4/21, when 12AB new section is introduced, in the 12AB, subsection 4 and 5 are ditto copied from 12AA, were introduced in 12AB for when the registration can be cancelled. Hardly it is 1 year old. Now that 12AB, 12 capital AB, subsection 4 and 5 are replaced in this budget, though the section is only 1 year old. Now when it can be cancelled? Because the old procedure, the commissioner has to call for, the AO has to report, so much lengthy procedure. Now it is streamlined. In the case of charitable institutions, if it is found that the terms of registration are violated, the money is not spent for the objects for which it is stated, or it has violated any other law, then in all these specifications, if the assessing officer reports, or commissioner or principal commissioner on their own, they have noticed it, through the risk management strategy, data will come. So the computer will throw some data that this charitable institution has not complied something. Then in all such cases, in a particular quarter, if the principal commissioner or commissioner gives a notice for cancellation, then within 6 months, the commissioner has to pass an order, either cancelling or not cancelling order also. We are not cancelling your registration. That is also an order, because they issue a notice to propose to cancel the registration. So by giving an opportunity to the SSC that registration cancellation or non-cancellation order has to be passed. That's how the time-bound program for completion of the scrutiny assessment of the charitable institution has been prescribed in this new section. Then the any related party, who is a related party in the case of charitable institution? Because in Income Tax Act, several sections refer the definition of relative and related party in different ways. So for section 11, application of expenditure, 13(1)(c), 13(1)(c), where any benefit, any income or fund of the institution is used for the benefit of the related party. Related parties list is given section 13(3) in this exemption chapter. So similar provisions are brought in the 1023C also. Now, though the commissioner is having the power to cancel the registration in case of a related party transactions, the for such violation, the taxable income will arise, and for the taxable income, they want to levy a new penalty section. That new penalty section, what they say, 100% for the first time violation, charitable trust shall not use the money. But in case they use the money, then that money is a violation. So whenever there is a violation, for such violation, the first time 100% of the violated money shall be levied as a penalty. And in case that is a 271E, 271E, one new penalty section has been introduced for these exclusive charitable institutions. So the directly or indirectly, the persons who are managing shall not get any benefit from the public religious or charitable institution. For example, teachers who worked as teachers for 20 years start an educational institution. They have to teach in the same institution. Then they have to take the salary. A teacher takes 1 lakh rupees per month. The officer finds 90,000 only is the reasonable salary. Then the 10,000 rupees per month, 1,20,000 per annum will attract 1,20,000 rupees penalty in the case of this charitable institution. first year. Second year, the same salary is drawn. By the time the assessment is completed, you are having the second year also over. Then for the second year, instead of 1,20,000, 2,40,000 is the penalty. So like this, they brought for all the violations, a new penalty section also has been brought in. Then, in case Section 11 exemption is not available, the best example, the best situation is a charitable purpose, as we all know, education, medical relief, relief to poor, any other object of public utility apart from preserving environment. So, any other object of public utility shall not carry on any business, even incidental business, main business, even if such business receipts, unless the business receipts are less than 20% of the total gross receipts of such an institution, it is no longer a charitable. By chance in the assessment, if such institution is found to be not eligible for Section 11 exemption, because it is not a charitable purpose according to the law, then how to compute the income? Then computation of income also is brought in by a special provision in this budget, saying that in such case, from revenue income, only revenue expenditure shall be allowed as deduction. 2. If such institution has donated for similar objects person, no donations will be given as deduction. No capital expenditure will be allowed, because normally under Section 11, income applied includes both revenue expenditure and capital expenditure. So you derived the fees, engineering college, students' fees. You used 70% for salaries and revenue expenditure, 30% for, or 20%, 30% for constructing buildings, or say buying computers, equipment, so on so. Revenue expenditure or capital expenditure, no difference. Both are eligible for application. Income applied, both revenue. Now the present situation. But so long as you are eligible for Section 11 exemption, that interpretation even now is valid. If once you lose your Section 11 exemption, then capital expenditure is not allowable. Only revenue expenditure is allowable. Similarly, any expenses in that year incurred out of a loan borrowal shall not be treated as expenditure. So no depreciation will be allowed, as it is already restricted under Section 11(6). So with all these restrictions, once the exemption is forfeited, taxable income most probably at a higher rate, higher volume is being arrived. That is the intention of this amendment. Then another important amendment. For several years, the basic question I have been facing also asked by several chartered accountants. Sir, is it cash system better, or is it mercantile system better for a charitable institution or religious institution? Is it cash system better or mercantile system better? I advised time and again, for those institutions where income consistently based on cash system is coming, temples, where is the question of income coming on accrual system? Will not be there. So better you go for cash system only, no problem. But the temple is having majority funds in the bank FD. The bankers will deduct the TDS and upload in the 26 days. Then year to year, if you are not able to match, then better that interest on accrual basis you admit as income, claim the TDS as refund, incur the expenditure. So depending upon the case, we used to advise cash system or accrual system. Now this year amendment is for these charitable institutions, both under 1023C, under Section 11, what they said, the income applied word only on payment basis will be allowed, on accrual basis, on providing in the accounts, the exact word used in the now amendment is irrespective of the method of accounting, on payment base only it is allowable from 22-23 assessment year. For the financial year now that is running also, you are having only February, March month. Don't think that on provision basis it will be allowed. For example, a university, an engineering college, gratuity, he will provide an entry on March 31st. Number of decisions in the case of charitable institution. Gratuity on provision basis also income applied allowable. To put a full stop, this amendment has come. On provision basis, nothing is allowed. Only on payment basis it is allowed. Even for this transition year, on payment basis it is allowed. And once it is on a earlier provision basis, say once it is allowed, second time it will not be allowed, because the transition period there may be overlap. So the 43B, 2 years back, 2019, they brought 40 capital A3, similar to business, mutatis mutandis, they brought for charitable institutions. 40 small a IA, TDS expenditure, any expenditure without TDS, just like business in charitable institutions also disallowed. Now this year, cash payments, just like 43B, in the case of charitable institutions, mere provision of expenditure is not entitled for application, that calculation of 85%. It should be on payment basis. So next, the cancellation provisions. As I told you, the 12AB4 1-year-old provision is amended, saying that if the income is used for other than the objects, for most of the charitable institutions, I have been advising, yours is for Annadanam. You do that activity only. For poor people, school scholarships are, we are going to pay. Education is not your object. Both are charitable purpose only as per the act, but in your objects, only one object. If you apply for other object, your registration can be cancelled. That is not an application in computing the total income. Strict rigid compartmentalization. So this year also the specific amendment that any expenditure other than the specified objects, if it is incurred, it can be, registration can be cancelled by the commissioner or principal commissioner. Similarly, if a business, incidental business is carried on, most of the charitable institutions, for example, a hospital having a pharmacy, medical shop, majority auditors, separate set of books of account they are not maintaining. Though income and expenditure is one and the same, for the separate set of books of account, that medical shop only you have to file form 44AB report also, and for the combined total institution you have to file form 10B audit report. This mistake they have identified, and now they said, in case separate set of books of accounts are not maintained, it can be a ground for cancelling your registration. This year amendment 12AB, new subsection 4, replacing the old 4. Where in the old 4 it is not there. So violation of any other law, last year also, last 2 years back they brought it for cancellation of registration. Now also they brought it for all the charitable institutions. Any other law, the country. Just like as I said, FCRA violation is there. Any other law substantially you have violated for obtaining the main objects, definitely it is a cause for cancellation of registration. So these are all the important amendments. They they brought for the charitable institutions. Now I will go to the general provisions. General provisions. In section 10.4, NRI's income, they brought small amendments like International Financial Service Center. If it is giving that NRIs, instead of bringing money directly to India through that International Financial Service Center recognized by government, if they bring their money and that financial service center invests in some infrastructure, say companies like aircraft, now ships also are included. So if they do that NRI funds money, the business in that particular respect, then they are eligible for section 10.4 exemption. Now, the section 14A, as we all know, 5 heads computing income starts with section 15, whereas 14 section, the 14A is introduced, saying that if any exempted income is there in the hands of an assessor, any expenditure in all the 5 heads shall not be allowed, which is related to that exempted income. This is the basic principle of 2000 8 they have introduced to my memory. This section 14 capital A. Now, banks, for example, as per RBI norms, they have to invest in some government securities. Government securities income is exempt. Limited company dividends earlier up to 2020-21 assessment year, limited company dividends, either individuals or limited companies exempt because dividend distribution tax was there in the hands of the company. So this exempted income, if they are deriving as part of their business income mainly, the total business expenditure proportionately, rule 8D they have introduced subsequently. So some proportionate expenditure, either direct expenditure or proportionate expenditure, shall be disallowed, shall be not entitled to under the head business. Again, several controversies have come, courts have held that this disallowance shall come only when exempted income is there. 1 year you may have exempted income, 1 year you may not have any exempted. Whenever there is no exempted income, where is the question of disallowance? Courts held so. This year amendment is, even if there is no exempted income, proportionate expenditure you have to arrive, and that shall not be allowed as deduction. Because now dividends have been becoming taxable. And this 14A mostly has become teethless. But even then, some government securities exempted income even now is there. So to some extent, this is the amendment brought in section 14A. When there is no income in the previous year, also some expenditure you have to identify related to that proportionately earning, that shall be disclosed. Then comes 37.1. What is 37.1? 37.1 is in the business head, you have specific rent, repairs, 32 depreciation, or say interest 36, like the specific deduction sections are there. 37.1 is any business expenditure not covered in the earlier sections specifically, which is incurred for the business purpose wholly and exclusively, shall be allowable as deduction. Now, while allowing that, we are having a restriction that if such business expenditure is in violation of any law, then illegal expenditure shall not be. Half an hour back I said illegal income is taxable. Now I am saying the already in the statute, not in the amendment, any unlawful expenditure or illegal expenditure shall not be allowed is already there. Now, for a legal business, illegal expenditure is not allowed. For illegal business, illegal expenditure is allowable. That is the other meaning, which is practical also. Because business itself is illegal, means all the expenditure is also illegal. Then you want the income taxable, then net income only you have to tax. But for a legal business, why this has come? The pharma companies were giving incentives to doctors. We can openly say, because ours is a closed room discussion. If you go to a doctor, if you write say X-ray, MRI, lab test, from those lab charges, 30% will what you pay as lab charges, MRI test, CT scan, 30% will come back to the doctor by evening. So this is known as referral fees. So several companies, for example, eyeglasses company. So ophthalmic medicines, glasses. That company will hire a prominent place and will ask a ophthalmologist to set up his practice there. Why? Because of that ophthalmologist is there, they will say, no room rent, sir. You practice, you have your fees. In addition, whatever the eyeglasses you refer, whatever the eye medicines you refer, in my sales, 10%, 20% I will give you as commission. So this doctor goes on writing those medicines and those. So is this expenditure allowable in the hands of the pharma company? Why? Because just like chartered accountant should not advertise, a doctor should not, for his practice sake, take the money from somebody. So this is a Indian Medical Association professional ethics prohibited. Doctor should not unethical practice. For receiving some money from somebody, you should not practice and then prescribe the medicines. So what is unethical for the doctor? Is it ethical for the company, pharma company? Some courts said yes, some courts said allowable, some courts said for business sake, sir, I have to do so many things, I do all these things, sir. So these are all the disputable areas. Some courts said yes, some courts said no. Now the budget said, in the case of such pharma companies, all such expenditure which is prohibited by some other law for some other person, you are incurring the expenditure, nothing doing in your hands, it is not allowable. So that's what they said. It's though to earn more income, what all I have done, I incurred the expenditure and incurred and more income, nothing doing, that expenditure is not allowable, income is taxable. So not only that, they, instead of incurring the expenditure, they induce sometimes some pharma companies outside India, they copy the patent, the formula, medicine formula of some other company, they violate, infringe the patent rights and then try to sell, market. These outside India. Some court incurs, say, levies some penalty on the pharma company. You have heard, if the case is 6 years, 10 years, it will be there. So such expenditure for violation of any other foreign law also is in computing the business income of this year Indian pharma company. Is it allowable is a question. So not only the infringement of Indian laws, even foreign laws infringement is also not allowable. That is this year amendment. So similarly, any benefit or perquisite which is in violation of the law, if you, that is also not only the money expenditure, so that is also not allowable. Okay, these all 37.1. Then 40 small a 2. What is this section 40? As we all know, up to 37 allowable expenditure, from 40 onwards disallowing expenditure. Which expenditure is not allowable? 40 capital A or say 40 small a. So now this 40 small a2 says any tax on income, that is income tax, is not allowed. Then tax is defined in the definition section. Tax includes surcharge only. Cess is not included in the definition section. So the now amendment is cess is also part of tax, because some courts said, for example, in the case of Cess Goa Limited, Bombay High Court said cess is an expenditure allowable. Now the government, with retrospective from 2005, this budget, what they said, from 2005 with retrospective, cess is not an expenditure. So along with income tax, what the cess you have paid is not allowable. So this is the amendment. So because to set right the, some courts said allowable, some courts said not allowable, but majority said allowable. Now the amendment is don't allow. That is 48 small. Then 43B. We all know 43B is any business expenditure normally as per accounting method accrual base allowable, but 43B specifically says some types of expenditure, any government duties, any public sector banks interest, public financial institutions interest, term loans, working capital. So these things are not allowable on accrual basis but on payment base only, because priority, employees provident fund, gratuity, like that they specified in. So here the interest is 43 capital B subclass E is there. Now there is a explanation to 43B, explanation 3. What it says, interest unless it is paid, it is not allowable, and specifically if it is converted into a loan, it is not allowable. Now some companies, instead of converting into a loan, the creditor converted that into a debenture. So debenture, is it a loan? Debenture is also a debt fund only. So now the amendment says no, because Aqua Technologies Limited 2021, the Supreme Court decision has come, it is allowable. To set aside that Supreme Court decision, the amendment has come. Any loan conversion, including debentures conversion, the interest being funded and converted into debentures also is not allowable expenditure. This is 43B. Then we deal with capital gains, normally 50 capital B. What is the 50 capital B? 50 capital B is slump sale. If a assessee sells one or more undertakings, because a company may have in 4 states 4 manufacturing companies, but one particular manufacturing unit is not interested to continue, it wants to sell as a unit. That means land, buildings, plant and machinery, everything as a unit you want to sell. Generally, how to arrive the capital gains in that slump sale, where each individual asset's value is not ascertained and as a lump, then it is a slump sale. So the slump sale is defined in section 242C. So the slump sale is defined in 242 definition 2, clause 42C is defined. There they used the word sale. So majority of the companies, whenever they really undertake some sale, they don't receive the consideration in money. They simply say they sell it to another company allots shares. Another company from its paid up share capital allots share to this first company, who is the transferor company. Is it a sale? Sale means there should be a prescribed money, consideration should pass on, no consideration, only shares are allotted. So like this, several courts said it is not a sale, it is a transfer. No question of capital gains, totally gone out. So now they brought the amendment in the definition itself. Slump, any transfer of an undertaking is a slump sale, now liable for capital gains. So that is the amendment. Then question comes as 68. We have been dealing with section 68 since a long time. 68 is any cash credit found in the books of accounts of an assessee during the previous year, if the source of such money is not explained, or the explanation given by the assessee is not to the satisfaction of the assessing officer, such unexplained cash credit can be taken as income. Then 115 BBE till 2016-17 estimate year 30%, now it is 75% plus surcharge, extra, and all this. Okay. So this 68 is already suffering. Then few years back, they amended 68, or say they in such a way that giving an explanation that in the case of closely held company, domestic company, private company, in the case of share capital and share application, the company has to prove not only the 3 things which are necessary for 68. What are the normal? A businessman borrows from his neighbor. What is the businessman has to prove? Creditworthiness of that neighbor, genuineness of the transaction, identity of the lender. These 3 things, yes, the courts held consistently. If the assessee proves these 3 things, genuineness, identity, and creditworthiness of the lender, it is sufficient. No question of section 68. The assessee has discharged his duty. Then to disprove it, the onus shift from the assessee to the assessing officer to disprove these 3 things. But for this, in the case of a closely held company, in the case of share capital or share application money, in addition to these 3, source of source also, that shareholders source also, company proved the, identified the shareholder, identified shareholder from his bank account has paid the money, but shareholder where from he got, source of source also has to be proved. Now that explanation, not only for the share capital, share application money, for any section 68 transaction, source of source also has to be proved. As I said in my introduction, opening remarks, a Pandora's box, any businessman, can he do the business only with public financial institution, or say non-banking financial institution, let us say, RBI permitted, RBI license. From there only he should borrow. He should not borrow from his brother-in-law. He should not borrow from his neighboring businessman. He should not borrow from other lenders in the town who are money lenders. In every town they will be there. If he once borrows from these money lenders, that money lender's source also proving is the burden of this businessman. Is it possible? For example, a money lender may rotate 1 crore rupees 3 times in a year. So in all the 3 business borrowers, the same lender has to prove his genuineness. Just like Sita was subjected by Rama to fire test. So the assessee has to undergo this fire test to prove his genuineness. So this becomes a lot of litigation, lot of difficulty. This where from the wisdom has come to this proposals of budget, because it is a really practical, very, very difficult. Because without borrowal, normal business cannot be done. Businessman maintains books of accounts and through check he borrows and he says, sir, this person is available. But his source also had to prove means again very, very say to the satisfaction of the assessing officer in this faceless assessment, scrutiny assessment to prove all these things, it's becoming difficult. But anyhow, section 68 is now amended, proposed to be amended. So we are all discussing in this today the proposals only. But anyhow, in according to me, it is a very difficult proposition. Then comes section 79, 79A. 79, the public sector companies strategic disinvestment, sometimes demerger, one company is becoming two, or say Air India like that is a demerger. So the losses carry forward. The 79 deals with it. Now they have amended this year also in the case of a public sector company. So the percentage, though it has come down, the losses carry forward benefits, how it can be affected. 79A, in the case of a search case 132, in case a search takes place, while computing the income of the search period, losses carry forward shall not be given. That is 79A, this year amendment. Because before the search, they would have had a lot of say carry forward benefit. But after the search, while computing the income for the search period, no question of allowing this carry forward. Now, section 80 CCD. 80 CCD is in addition to 80C, in case the employer being a central government, the employee a central government employee, in case it opts for this new pension scheme, the Atalji's pension scheme, then up to 14% of his salary, he can claim deduction under 80 CCD. This was there till last year only for central government employees. Now this budget proposes even for state government employees, if the employer gives up to 14%, then you can claim deduction. So that's what the limit enhanced for state government employees also at par with central government employees up to 14% in 80 CCD. Now 80 DD. 80 DD is a new section, sorry, old section, where for senior citizens, the 80 DD, the medical expenses up to 75,000, where specified is up to 1,25,000 are deductible. Now the amendment is, in the case of an assessee who is having a dependent, for the dependent's sake, physically disabled, handicapped dependent's sake, if I pay the money, insurance premium, it is allowable. The expenses, medical expenses incurred are allowable. For his future benefit, if I buy an annuity, annuity falls on certain day and the payments are now made allowable. Now, the 80 DD says that deduction in case during the lifetime of the proposer itself, if the lifetime of the proposer itself, if the proposer is more than 60 years, senior citizen, then the annuities received for the sake of dependent are deductible. So not after the death what they get, but now during the lifetime of the proposer himself. So this is a provided he is a senior citizen. Then 80 IAC, the startups. So Make in India concept. The startups, any 3 years in the first 10 years, income exemption can be opted. 80 IAC. So the manufacturer should have the startup should have commenced its operation, registered and commenced its operation. So the date is extended by 1 more year. 31/3/23 is now increased to 31/3/24 for the sake of 80 IAC. Next comes the TDS provisions. We are having 194 IA. Any immovable property purchaser, in case the purchase value is more than 50 lakhs, must deduct from the sale consideration what he is paying 1%, must deduct 1% from the sale consideration whenever he pays to the seller. I pay in 3-4 installments, one at the time of agreement, then second installment, third installment. From the sale consideration, 1% has to be deducted. This is applicable. Okay. Now, this has come from 1/6/2015. This section has been introduced. This year, what there is a condition that sale consideration should exceed the total sale consideration should exceed the 50 lakhs value. Up to 49 lakhs, no TDS section will apply. Now the proposed amendment is not the consideration, total consideration of that particular property. Actually, when this section was introduced, is this 50 lakhs qua the property or qua the purchaser or qua the seller? That means 2 sellers sold for 80 lakhs, purchaser is 1 purchaser for 80 lakhs. So 1 property. So with the purchaser, because he is paying more than 50 lakhs for 1 property, is it applicable? For each person 40 lakhs, 40 lakhs, not applicable. So then they said qua property only. So like that, several debates are. Or say 1 property 80 lakhs, 2 purchasers are there. Earlier example I said 2 sellers, owners. Now 2 purchasers. Each purchaser is paying less than 50 lakhs. Then not applicable. So like that debate and then discussion was there. Now the amendment is this year. Don't worry about the actual consideration. SRO value, if it exceeds 50 lakhs, on the SRO value deduct 1%. Now my question comes, though this section also from 1722 applicable. Now the question comes, 2 crores property I am buying for 1 crore 50 lakhs. That 1 crore 50 lakhs I will pay in 3 installments, 50 lakhs, 50 lakhs, 50 lakhs. At the time of agreement, 2nd month, 4th month. So 3 installments I will pay 350 lakhs. I know that SRO value is 2 crores. Now what the section says, on the SRO value deduct 1%. So each time what is proportionate SRO value, not the payment. So you must arrive the proportionate SRO value and then deduct. Otherwise the TD is defaulter, interest. So many things. So this all work involvement is for this, of course, TAN number need not be taken. Directly it is a statement come challan. You have to pay that 194 IA is there. So the work on the professionals is increasing like anything, just like that I said. So this 194 IA, the existing TDS section being amended, replacing the sale consideration with the SRO value. Now 194R. What is this 194R? A new TDS section. Already in section 28, any businessman or a professional man receives something as a benefit or a perquisite on account of his business. I am a chartered accountant. I argued a good case in appeal and I got much relief to the assessor. I charged a bill. He gave me a bill. On the occasion of my grandson's birthday, by chance I invited him. He gives me 50,000 rupees worth a gold article. Now, the other person, if he is a businessman, and he wants to claim this as expenditure, the person who receives is already has to admit, as per the Act, Section 28, either a professional during his profession receives in kind or in cash any perquisite or benefit is taxable income. For a businessman, normally for business people, you know, apart from turnover discount, you cannot call it as a perquisite or a benefit. So the benefit in the sense, the sale price is reduced, discount, cash discount is given or turnover discount is given. So now this 10% TDS, if you achieve this much turnover, I will give you a foreign trip for you and your wife, or I will give you a motorcycle, I will give you a car, I will give you a fridge. So like that, whenever the business enterprise is giving as expenditure, it is booking and parting with some money in cash or in kind, the 10% TDS is introduced in 194R. For this, the basic limit is 20,000 rupees. So more than 20,000 rupees in case. Now the question comes, the person, a distributor is giving to a retailer, as I said, a motorcycle of 50,000 rupees. Then what he has to do? The retailer first should pay 5,000 to the distributor. The distributor, that 5,000 rupees he will pay to the government as TDS money on this 50,000 rupees motorbike, and will hand over the motorbike as business promotion expenditure to the retailer. But in case the distributor himself wants to pay the tax on behalf of this retailer, he must gross up. That means maybe that 56,500 he should, because this 50,000 will become 90%. What is 100%? So you should gross up and then pay. So this is the implication of this. Then 194, yes, already I have virtual digital assets 1%, whoever is a buyer, that is the TDS section. I have already told, where for specified persons it is individual HUF more than 50,000 rupees. For other entities it is 10,000 rupees. Then comes the another TDS under TC's provision. Last year we have seen for the past 10 years we have been seeing where the PAN number is not given, deductor has to deduct and upload in the name in the PAN of the deductee. If the deductee is not having PAN, 206 AA, use 20%. Several banks, without obtaining the PAN number of the depositor, deducted 20% of the interest and uploaded. That's also spicy. So now, after that, 206 AB section is introduced in the TDS. What it says, in case the deductee has not filed his return for 2 years, the deductee has not filed his return for 2 years, and in his name already TDS or TCS together is exceeding 50,000 rupees, then the deductor has to deduct at normal, not at normal TDS rates, double the TDS rate or 5%, whichever is higher. That was the last year's position. So last year's position, what it is? A deductor who is liable to deduct under any of the sections of this, for example, contractors. A contractor is giving to subcontractor. In the name of subcontractor, already TDS is deducted, but never the subcontractor files the return. Then the main contractor's duty is to deduct double the rate. Earlier he was deducting 2%. Now we have to do double the rate of 2% means 4% or 5%, whichever is higher. For example, rental TDS 10%. Never he filed, the landowner, building owner not filed the return of income. The TDS accumulated is each year more than 50,000. Then instead of 10%, 20% you have to deduct, because the other fellow deductee has not filed his return of income, is the existing section. Now this year amendment is that 2 years while a non-filing return reduced to 1 year. So for 1 year he has not filed the return. Now you apply this section. So while introducing, they introduce liberally, and now this is a, if 1 year return filing is not there. You can see, seeing his PAN number, whether he filed the return or not, number one. Number two, whether he has a TDS and TCS is there. So these amendments are 206AB for TDS, double the rate, all these things. 206 double CA for TCS. So similarly, while collecting the tax, TCS also, if the other fellow has not filed the return, then TCS has to be double the rate or 5%. So this is how the section 2 years is reduced to 1 year. Now I will go to the final, because 2 hours time is given to me. Last 10 minutes time is there, but anyhow, I will try to cover up the remaining things, whatever that is important. There may be several things, around 84 amendments are there, sections, some are clubbed together. So majority we are covering. Now I will go to the penalties. So the penalties, as I have told you, the 271 AAB, in the case of search, 30% if it discloses during the search and pays the tax. Only while filing the return and assessment it is there, 60% of the assessed income. So that is the penalty. This can be levied by the assessing officer with the prior permission of the higher authority. Now the 271 AAC, as I told you, 68, 69 ABCD, 115 BBE wherever it is there, apart from paying that 75% plus 3% cess, 10% in case it is not paid, that 75% is not paid as advance tax, then penalty can be levied 10%. So now 271 AAD, what is the last year introduced? If any assessee claims any expenditure which is not genuine, fake purchase invoice for the sake of ITC, any false entry, so then 100% of that entry, 100% of that invoice is the penalty. In section 271D, the assessing officer earlier is having the power to levy the penalties. Now in these sections, this year amendment is even the CET appeals can levy the penalty. As we all know, 246 capital A, the appeal, first appellate jurisdiction under the Income Tax Act is to the Commissioner of Income Tax Appeals. Now it is faceless appeals, except such cases, survey cases, where material is found. Now 90% we are having faceless appeals, that is National Faceless Appeal Center, that is CET appeals. Now the power under these sections penalty, though the assessing officer has forgotten or not levied, if the matter is in appeal, CET appeals also can levy the penalty, is the proposed amendment. Now one important thing. Earlier, 3 years back, if one assessment year you are not able to file the return, you can file belated return within next following assessment year. That means 21-22 is the assessment year. 21-22 assessment year, 21 October, 21 July, 21 December, doesn't matter. Not only 22, up to 23 was there earlier, 1 more year extra. It was reduced to from 17-18, except that year return, any early return you cannot file. Only 1 year return you can file now electronically. Early years you cannot file. Now that period, even that year is reduced to, as per the Act, December 31st. Beyond December 31st, you cannot file the return. Now the government said, we will allow you to file belated return. We are giving a new name known as updated return, this year concept. But is this updated return practical or not? I will explain you in 10 minutes the provisions. Is it really worth opting? What is this? If an assessee forgets to file his return of income in the assessment year, naturally, after the previous year in the assessment year, he has to file the return. If he failed to furnish his return, in the next 2 years, he can opt. If in the very first year itself, that means succeeding the assessment year first year, if he opts to file his return, apart from the tax and the interest, 25% of the tax and interest he must pay as additional tax. So this additional tax computation is there in section 140 capital B. A new section 140 capital B is introduced in this budget, which defines what is that extra you have to pay. It is nothing but a penalty. To avoid the penalties, underreporting, misreporting, 270 capital A, you have not filed the return, they will issue 148. Even if they issue 148 and you file the return and pay the tax, it is a misreporting. 270 capital A 6 will not apply. Underreporting 50% of the tax, then 200% of the tax. So instead of avoiding all these penalties, the government says, we are giving you an opportunity. You come clean, you file voluntarily. What is that? Within 1 year of the end of the assessment year, 25% of the normal tax and the interest. You first compute the normal tax, first compute the interest ABC, and total on that pay 25% extra as per section 140 capital V. Then we will accept the return, no problem. In filing such return, in calculating such a tax, any TDS, any TCS, any advance tax, you deduct. Remaining tax, what is payable only, you will take into account. This is what the government says. In case second year also you have forgotten, third year, that means in the sense, and in the assessment year you have forgotten, in the immediately following assessment year is the first year, 25% you have not opted. Then comes the second year, that is the second year from the end of the assessment year, 50% of the assessed tax you have to pay. Then file the return of income. And this also is, this option is not available in the case of a search case, in the case of a already identified and notice issued case, in the case of a prosecution launched case, in the case of a already detected by this system, risk management system, so many conditions they said. So the section is not applicable. It should be a purely voluntary. Before the department issuing a letter or the inquiry, conducting an inquiry, a survey or such like that. That's what they said. Similarly, by filing this return, you cannot claim refund. By filing this return, you cannot claim losses set off. Those conditions also they are included. So this updated return is given in section 139, a new subsection 8A, and the tax calculation is given in 140 capital B. This 140 capital B and 139 8A says, where no return is, regular return is filed, you can use this method, or where already return is filed, but some defect, that means to increase the income only, not to decrease the income. You find a defect to increase the income. Some income you omitted, come here. Some loss you failed to claim. No. Exemption you have failed to claim. No. This section is not applicable. For only enhancing the tax, you use this route. This is what the updated return, that is 139 HA coupled with 140 capital B is introduced. So the 148 already last year has created several ripples. Delhi High Court, thousands of writs were filed. Why? In April, May, June of 2021, 148 notices are given because CBTD said, though 148 issuing 6 years time is over by 31st March 21, I am extending the date up to June. So they extended. Officers also who have forgotten that 148, because the new 148 limits are 3 years and 10 years only in specified circumstances. So hurriedly they issued all the notices. Ultimately, Delhi High Court said, when a new law has come repealing the old law, Why under the old law you want to issue notice? They are all not valid. What is the new law? After 1421, if you want to issue a notice under section 148, first, that is income escaped. First, you should give an opportunity to the assessee. 148 capital A, last year budget, new section introduced. First, ask him, is it right? Have you really got taxable income not filed? I am giving an opportunity. 148 notice should be given. So without giving 148, straight away you give 148. All these are all not valid. Then the department now taken the matter to Supreme Court. We should wait and see whether the Delhi High Court decision will uphold or not. Now, casually, if you speak, last year what they replaced the old 148, time tested 148 with the new 148, and again brought 148A is a self goal. Government in its hurry to make simplification, only 3 years reopening. From beyond 3 years to 10 years, we can reopen only if some income is believed to have escaped assessment, which is resulting in asset only. Any other mistake, you cannot reopen. Government itself proposed that amendment, tying up through its hands a rope to tie up its own hands. So that 148, 148A were most assessee friendly. Okay, we thought this year what they amended 148 scope. Even there is an audit objection, we can issue 148. It is also income escaped. Any risk management strategy throwing a red flag, computer system, it is also 148 can be revoked. So the 148 scope is enlarged, number one. Number two, last year what the 148A notice also, an assessing officer only with the permission of a principal commissioner should issue a show cause notice to propose 148 assessment. 148A notice shall be given. Now this year they diluted 148A. Now 148A is amended, 148B is introduced, saying that no, prior permission of the principal commissioner is not necessary. The assessment order shall be, assessment shall be completed with the prior permission of the commissioner only, higher authority only, the assessment shall be completed. That means they can issue notice. So almost what the new provisions they brought, now they are diluting, and then as if the old 148 itself, as if, I don't say 100%, but now the officer is having reason to believe some audit party will come, audit party will ask you to come, you didn't go, they will write some, whether it is logical or not. Then officer also, I do believe that something is escaped, come on, reopen. So a closed 143.3 assessment will get reopened. So this all batting, second time batting, third time batting from the beginning. So with the department you have to be, government sensing the difficulty has brought new provisions. Instead of strengthening the new provisions, once again they are going back to the old provisions. So this is the difficulty of the assessees. I think in the given time, on a Sunday evening, though the branch invited me, I am happy to read for the sake of this lecture once or twice and then share my thoughts. I must appreciate the members who participated. They are sacrificing their time and then listening, for the sake of learning the subject. So I thank the organizers. If one or two questions are there, I will take. Otherwise, for the branch to sum up.
Yes, sir. Thank you, sir. Thank you. But anyhow, as a part of this, we have some questions on the chat box. I wish to request you to say kindly address that. I will read out, sir. First question was 1 second. 1 second.
First question I am seeing. First question is this updated return for non-filers also? Yes is the answer. Yes is the answer. Yes is the answer. Next.
Next, funded interest term loan will come under 43B. That is just approved on CC account converted as TL due to COVID-19.
Even then, the funded interest is not allowable under 43B. Yes, sir.
Okay.
Yes, because of the explanation below the 43B.
Okay, fine, sir.
Sir,
And I think there was one question. Okay, yeah. Sir,
I have a question, sir. Good evening, sir.
Good evening.
And in fact, we are very happy to listen to you, sir. And we are thankful to you for spending your Sunday evening with us and precious time with us, sir. Thank you. The question is that, sir, in practical cases where the religious trusts, especially temple, gurudwara, whatever it might be, you said for the construction purpose, if it is being donated, the donors can enjoy ATG. Is it the donation under the same PAN number or the same PAN?
No.
Should there be a separate trust for the purpose?
Not necessary. The same trust only. The temple gurudwara should approach the commissioner to get the ATG recognition.
Okay.
They need not have 12-year registration or not. Even if they have or not. So they should specifically, this is a separate corpus fund. Separate corpus fund. They should approach. If you go through that ATG, they says a prescribed authority shall give them the ATG recognition, then they should receive. Then that money is a separate corpus fund. That money shall be used only for that purpose. Government wants to preserve this. So since a long time this is there on ATG, so they can receive that money and then they can use that money.
Okay, sir. And another doubt is that, sir, you said about the amendment in section 80 DD, the 75,000 and 1,25,000. Some insurance annuity payments are included. That was. Can you please repeat it for our
yes, sir.
benefit, sir?
So what they said, not the actual expenditure alone, not the actual expenditure alone. The person who receives, who receives an annuity during his lifetime. So because the annuity after the death of the policy holder, actually for the sake of a dependent, I take a policy.
Okay, sir.
I take a policy. The policy normally will have the terms that after my death, you give the annuities to that dependent. I have a spastic child, let us say. So after my death, you give the annuity monthly 10,000 rupees. Now I am giving you this policy. I purchased it. Now that policy, if it is having the person who has taken, I myself, a senior citizen, my earning capacity is less. I cannot pay the money to meet the expenses. Now I received the annuity. Now I received the annuity and then annuity is income. So annuity deduction shall be eligible. So now they have given the deduction during the lifetime also, who himself is taking for the sake of a dependent to incur the expenditure. That is.
So it neither need to be treated as an income.
First you take the income and then claim
and in addition, it can be claimed as a deduction.
Deduction. Treat as income. First of all, any annuity is income, and then treat as expenditure. If I have no dependent, and normally people take annuities, just like our CA professionals, when they are young age, they buy an annuity. That means they deposit 10 lakhs. At the age of 60, you please give me annuity. Every month 10,000. Then that annuity is other source income, taxable.
Okay.
So only for a dependent sake you have taken an annuity. So though the dependent is alive and you are alive, if you are a senior citizen, then this deduction can be claimed.
Okay.
Sir.
Okay, sir. And similarly, one more doubt regarding the valuation with respect to the 194 IA section. Okay,
so the
SRO is basically the guideline value, sir.
SRO value. SRO nowadays all the sub-registrars put in the website their value for every property.
Okay.
So in case the actual consideration is less than the SRO value, the strict wording in 194 is on the consideration at the time of payment, deduct 1%. Now, instead of the consideration, in case the SRO value is higher, on the SRO value only 1% has to be applied, not on the consideration. Just like your 50C, just like 50C capital gains calculation, the TDS also is now on SRO value rather than the actual consideration, in case actual consideration is lesser than the SRO value.
Only in the case of actual consideration being lesser than the SRO.
Natural.
Oh, okay.
But one thing, sir. But so this is is it that the same? There is a irrespective of the number of buyers and sellers, or that is not a condition at all.
Irrespective of
quasi property.
for the property, irrespective of number of buyers and sellers. Yes.
Yes.
So assuming like, actually one of there is Betriel sir posted a question also, sir. So what he has questioned is, Betriel sir, in fact, unmute பண்ணி கேட்டறலாமே.
One property value, stamp value.
No matter
example, 3 person buying one property for 75 lakhs. TD is applicable. Yes, the query property they said where the property value exceeds, because it's one sentence, where the property value exceeds 50 lakhs rupees, the TDS provision will apply. Yes, sir.
Sir. Sir, usually in the case of few apartments which are under construction, they will be paying in several installments, sir. The TDS incidence comes from the very first installment itself, irrespective of whether. Yes, sir. And the SRO valuation, the guideline values in some cases, very rare cases, it may be increased over in between the installments also. In that case, there is a possibility that sale consideration would be lesser than the SRO, and in that case also we have to.
Sir, for an apartment seller, just like 50C, 43CA is a section. 43CA is a section where deeming provision be deemed business income, because he is selling the apartments rather than the actual consideration, the SRO value. When the SRO value, because you know your question says on the first day of I paying the installment, one SRO value will be there.
Yes,
On the last day of I paying the one installment, another SRO value will be there. Which SRO value is applicable to me is your question.
Yes,
So,
sir.
when on the first day when you are entering into an agreement, sale agreement, what is the SRO value? What is the total sale consideration you agree? Compare both. Then if the SRO value is higher, on that SRO value only proportionately go on paying the TDS. Don't worry about the subsequent things, because your transfer takes place as per the agreement in the initial payment, not the subsequent payments. Subsequent SRO values ignore. That is the answer.
Thank you so much, sir.
Okay. Sir, branch organizing. Betriel sir.
Yes, sir.
முடிச்சுடுங்க இல்லையா?
What of?
யார் கிரீஷ் சார் ப்ரொபோசல் ஓட் ஆஃப்டர் சார்?
இல்ல சார், நோ சார்.
I take this opportunity to thank the speaker on behalf of the managing committee for this detailed analysis of the direct tax provision in the budget. Really surprised to hear a lot of amendments, even though it has been that nothing is in the budget. Maybe nothing for a common man who expects freebies and benefits from the budget. But as a professional, we have a lot of things to take as per the amendments and new provisions made in the budget. As chairman told in the beginning, another CPV session will be done in the provisions aspect of indirect tax, especially for GST, for the benefit of the members. Finally, I wish to thank the members of our branch for the support they extended to our committee for the past 3 years. The new management committee will be active from another fortnight, maybe. Once again, I thank all the participants as well as the speaker.